Hello, this is Mark Brower with Mark Brower Properties coming to you with a July 2023 market update. Two headlines I want to cover and show some slides on is demand for housing sales is declining faster than supply. So prices have been moving up, but they paused, they retreated a little bit this last month. I'm going to show you some stats on that. Also, rental home supply is growing, and that's prompting a little softness in rents. So we're going to show some data on that as well. This data is coming from the Cromford report. This is showing the median home price trend over the last year and a half. We see the decline in median sale price last year prompted by higher interest rates, things bottoming out earlier this year and then trending up nicely. But unfortunately, we had a tick down last month. So we're going to watch this. We're not calling this a trend yet, but we're going to watch very closely what housing prices do through the rest of the summer. But prior to that, we were on this very nice projected 18% annualized appreciation rate, regaining some of the losses from last year. Here's what's behind that. This is the Cromford Market Index. They're showing the change in buyer demand. They're saying it's down 4.1 points according to their rating. And supply continues to dwindle by 2 points, but because the demand is declining faster than the supply, it's pushing us closer to a balanced market, and then eventually to a buyer's market. So still technically in the green, still a seller's market according to Cromford. Here's some data on the rental market. When supply is high, renters have a lot of choice, lots of options, and that's what we're seeing here now. The highest recorded supply in rental homes, at least the last 5 years, is what's on the market now. And so, especially in some of the inner markets, we're having to see some price decreases, longer days on market, as residents just have more options to choose from. They're being a little bit pickier. Here's another slide about the rental market. The blue is the median list rental rate, and the green is the closed rental rate. So we're seeing that landlords aren't quite getting the prices they're hoping for. They're having to concede a little bit, and rents are kind of generally flat over the last year and a half or so. Here's another graph that shows the year-over-year change in rent. We're down 0.6% over the year, so essentially flat, but hopefully trending up. So we're going to watch that, continue watching that closely. Here's a slide about inflation. Finally, it looks like inflation's under control. This is important because when the Fed feels like inflation's under control and they want to stimulate the economy, they could lower the Fed funds rate, which should impact the bond market and could bring mortgage rates down. Here's a slide on the historical mortgage rates. They're hovering right around 7%, just under 7%, and investment mortgage rates are about a half a point higher than that. Here's a national headline that Congress, this law is not passed yet, but there's something going through Congress at the federal level that investors that have 50 or more properties, single-family home rentals, might lose some financial incentives to deduct interest and depreciation on those properties. Well, none of our clients have over 50 properties yet. However, this is good news for small investors because when we have less competition from these large institutional players, it gives us more options to buy rental properties. There's less competition. Usually we're going to get a better deal. So that we're going to watch that, and hopefully there's some good news on the horizon there for us smaller investors. This is just a slide that I wanted to include this month to show how smart you are for owning rental properties. In the last 3 years, your home value has increased 50%. So that means if you put $100,000 down, you bought a $400,000 home 3 years ago, you now have $300,000 in equity when you started with just $100,000. So that's pretty cool. And then here's another slide put out by Cromford Report that even at higher interest rates currently and higher home purchase prices, 450,000 is the example they're using here. If we assume a 4% appreciation rate, which is pretty modest in some of the growing emerging markets in the valley here, you're still getting some really nice appreciation, and you're still able to write off your mortgage interest. The more mortgage interest you pay, the larger that write-off is. So kind of a cool infographic there. Finally, pro tip, if you want to add to your rental portfolio, it's typically advantageous to do so. You have more leverage from September through December, and it's usually a better time of year to sell from March through June. So for anyone that has been thinking about adding to your portfolio, give us a call. Let's set up a meeting, talk about specifics of your scenario, and where that connects with market opportunities. We're still generally seeing prices on the dip, so there's still some good buying opportunities out there. And despite the higher interest rates, we think the long-term picture is still very compelling. Thanks so much for watching.